Jordan sits at a kitchen table with two browser tabs open, one for a mortgage calculator, one for an apartment listing 3 blocks away. Same square footage, same neighborhood. Two completely different monthly numbers. Staring back, the voice in Jordan's head sounds like every parent, every uncle, every finance influencer from a decade ago. Buy a house, they all said, because rent money is money you never see again. That advice made sense in 2012, in 2015, even in 2019. In 2026, it might be the single most expensive piece of financial advice still floating around, because the math underneath that advice has shifted so much that the old rule of thumb doesn't just bend anymore, it breaks. This is not a video telling you to rent forever, and it's not a video telling you to buy at any cost. It's a video that runs the actual numbers for 2026, the real mortgage rates, the real home prices, the real rent data, so you can see which side of the math you're actually standing on. For most of the last 50 years, the rent versus buy decision wasn't really a decision. Mortgage rates sat in a range that made monthly payments roughly comparable to rent, sometimes cheaper. Home prices climbed steadily, usually a few % a year, slow and boring, like a savings account with better PR. Every mortgage payment you made was partly forced savings, building equity, whether you felt disciplined that month or not. Rent, on the other hand, just disappeared into a landlord's account every single month, building nothing for you. So the math was simple. Pay roughly the same amount either way. But one path builds you an asset, and the other doesn't. Under those conditions, buying wasn't just emotionally satisfying, it was almost always the better financial move too. That simplicity is exactly what got baked into the advice your parents gave you. The problem is, that advice was built on a specific set of numbers, and those numbers don't exist anymore. Here's the first number that broke the old equation: the 30-year fixed mortgage rate. As of June 2026, Freddie Mac puts the average 30-year rate at roughly 6.5%. That's down from the painful 8% peak of 2023, but it's still more than double the sub-3% rates buyers were locking in back in 2021. Double the rate doesn't just mean a slightly bigger payment. It reshapes the entire monthly cost of owning a home. The second number: home prices never came back down after the pandemic run-up. The national median existing home price sits around $429,000 as of May 2026, according to the National Association of Realtors. Back in early 2020, that median was closer to $329,000. That's a jump of roughly 23% in 6 years, while typical household income grew nowhere near that fast. So now stack the two together. A much higher price, financed at a much higher rate, on a median-priced home with 20% down at 6.5%, the mortgage payment alone lands around $2,150 a month. Add property taxes, homeowners insurance, and basic maintenance, and the realistic, all-in monthly cost climbs toward $2,700 to $3,000. Now compare that to rent, where the national picture looks almost frozen by comparison. Apartment List puts the national median rent at $1,379 in May 2026, actually down 1.5% from a year earlier. Other trackers that include more single-family rentals, like Zillow and Apartments.com, put typical 1- and 2-bedroom rents closer to $1,650 to $1,900. Either way you slice it, renting a comparable home is running hundreds, sometimes well over $1,000 cheaper per month than owning one. Research from Construction Coverage backs this up at a national level, finding the typical monthly mortgage payment is now about 20% higher than the typical rent payment. Out of 838 cities that study analyzed, only 95 of them still favor buying on a pure monthly cost basis. That means in roughly 9 out of every 10 American cities right now, renting wins the monthly math. Full stop. This is the part of 2026 that genuinely is new. The gap between renting and owning hasn't been this wide in over a decade. There's a second layer to this that rarely makes it into the headlines: who can even qualify to buy in the first place. Lenders generally want your housing payment to stay around 28% of your gross income. Run that math on the median-priced home in 2026, and you need a household income north of $112,000 to comfortably qualify. The actual median household income in the United States sits closer to $80,000. That's a gap of roughly $30,000 between what a typical household earns and what they'd need to earn to buy a typical home. The National Association of Realtors tracks this with something called the Housing Affordability Index, where 100 means the median family has exactly enough income to qualify. For most of the 2010s, that index regularly sat above 130. Meaning buyers had room to spare. Through 2026, it's been hovering right around the break-even line of 100. Some months a little above, some a little below. This isn't a renting versus buying preference question for a huge slice of the country anymore. It's a qualifying question, which is part of why first-time buyers are increasingly putting down closer to 10% instead of the traditional 20%. Just to get a foot in the door. So let's build the strongest possible case for renting right now, because it deserves a fair hearing. Lower monthly cost is the obvious one. Hundreds of dollars a month freed up. That isn't locked into a mortgage. That freed up cash, if you actually invest it, has a powerful long-run home, the stock market. The S&P 500 has historically returned somewhere around 10% annually over long stretches of time, according to data cited in multiple 2026 housing analyses, including a study from Tailwind Economics. Home prices, by contrast, have historically appreciated closer to 3.5 to 4.5% a year, and in 2026, that pace has actually slowed even further, with some trackers showing national appreciation under 2%. So in pure rate of return terms, equities have simply outpaced housing for decades. Renting also buys you flexibility that owning doesn't. No 6% agent commission if your job moves you across the country. No surprise. $12,000 roof replacement eating your emergency fund in the middle of a slow income year. No property taxes that quietly creep up every year regardless of what your paycheck is doing. For someone in their 20s or early 30s who isn't sure where they'll be living in 3 years, renting isn't a consolation prize, it's the financially correct choice, and the rental market in 2026 is, in many places, actually cooperating with renters. National vacancy rates sit around 7 to 8%, the highest in years, largely because of a multi-family construction boom that started back in 2023. Cities like Austin and San Antonio have seen rents fall outright, down 3 to 5% year over year, as new supply outpaces demand. That gives renters in those markets real negotiating leverage, something that simply didn't exist during the 2021 and 2022 rent spike. So the renter's case, in one sentence, lower fixed costs, a historically stronger investment vehicle for the difference, and far more flexibility. Now, let's build the case for buying just as honestly, because the renter's case has a weak point hiding inside it. That weak point is one word: discipline. The renter's case only works if the person renting actually takes that monthly savings and invests it, consistently, for years, without touching it. In the real world, a lot of that saved cash quietly drifts into nicer dinners, upgraded vacations, and a slightly better car. A mortgage payment doesn't ask your permission. It just goes out every month. And a piece of it becomes equity, whether you feel motivated that day or not. Economists sometimes call this forced savings, and it's a genuinely powerful behavioral tool, even if it sounds unglamorous. This gap between what renters could build and what they actually build shows up clearly in household wealth data, where homeowner net worth dwarfs renter net worth by a massive multiple. Buying also locks in your single biggest fixed cost, the mortgage payment, for 30 years. Rent has no such ceiling. It simply moves with the market, year after year, lease after lease. Someone who locked in a 3.5% mortgage back in 2020 or 2021 paying essentially the same housing cost today that they paid 6 years ago. Meanwhile, renters in plenty of cities have watched their payments climb 15 to 25% over that same stretch. Ownership also comes with tax advantages renting simply doesn't offer, mortgage interest deductions and property tax deductions among them. And there's leverage, A tool available to homebuyers at a scale almost no other asset class offers. Regular people put 20% down on a home, and you control 100% of an appreciating asset with borrowed money at a fixed, stable rate. If that home appreciates even modestly, your return on the actual cash you put in can be dramatically higher than the home's raw appreciation rate. None of that happens automatically with a brokerage account, where every dollar of return is just a dollar of return on your own money. So the owner's case, in one sentence, a fixed cost that inflation can't touch, a forced savings mechanism most people actually need, and leverage that amplifies even modest growth. So which case wins, on paper, with real numbers? A 2026 study from AdMortgage modeled exactly this question across 250 America's largest cities. The setup? A buyer with a 30-year fixed mortgage at 6.11% against a renter who invests their down payment in the S&P 500 at a 10.35% assumed return. Under the simplest version of the test, where the renter only invests their initial down payment and nothing else, buying wins in every single one of the 250 cities. That's the entire sample, most of it, all of it. Then they made it harder on buyers, testing a disciplined renter who also invests every dollar of monthly savings whenever renting was cheaper. Even under that tougher, more generous to renters scenario, homeownership still came out ahead in 199 of the 250 cities, close to 80%. That's a notable result, because it means even a highly disciplined renter, doing everything right, still loses the long-run wealth race in most American cities. But that remaining 20% matters, because it's concentrated in very specific, very expensive places. In Los Angeles, projected home equity after 10 years topped $1.15 million, and renters who invested everything still came out about $163,000 ahead. San Jose, San Diego, and San Francisco showed similar patterns, with renter advantages ranging from roughly $169,000 to $449,000. Those are the cities where home prices have run so far ahead of rent that even leverage and forced savings can't close the gap. On the flip side, 26 cities in the study actually cost less to own than to rent on a pure monthly basis. Detroit topped that list, where owning runs about $799 a month cheaper than renting. Cleveland, Baltimore, Birmingham, Philadelphia, and Chicago all showed similar, if smaller, ownership advantages. In those markets, there's almost no financial argument for renting long-term. The monthly math and the long-run math both point the same direction. There's a simple tool that captures most of this regional variation in one number: the price-to-rent ratio. Take the home price, divide it by the annual rent for a comparable property. That's your ratio. A ratio under 15 generally favors buying. The home price isn't that far ahead of what rent would cost you over time. A ratio between 15 and 20 sits in a gray zone, where your personal timeline and savings habits start to matter more than the math itself. Above 20, renting tends to dominate, and above 25, it's usually not close. San Francisco's ratio sits near 36, San Jose closer to 40, Seattle around 36 as well. Those numbers explain, in a single figure, why coastal tech hub renters in that AdMortgage study came out so far ahead. Compare that to a city like Tulsa, with a ratio around 16, or plenty of Midwest metros sitting even lower. In those markets, the gap between what you'd pay in rent and what you'd pay to own simply isn't large enough to justify renting long-term. The lesson here is uncomfortable for anyone hoping for one national answer. Your zip code matters more than any nationwide headline. There's one more number that ties everything together: the break-even horizon, meaning how many years you need to stay in a home before buying actually beats renting. Historically, with lower rates and lower transaction costs, that break-even point sat around 5 to 7 years. With mortgage rates near 6.5% and closing costs still running 2 to 5% of the purchase price, that horizon has stretched out to roughly 7 to 14 years in most markets. Selling a home isn't free either. Agent commissions alone typically run 5 to 6% of the sale price. So if you buy and then move again in 2 or 3 years, you're very likely to lose money once you account for those transaction costs, regardless of what the market did. This is the single biggest reason financial advisors keep repeating the same warning: don't buy a home you don't plan to live in for at least 5 to 7 years. In 2026's higher rate environment, that warning deserves to be even louder. The safe runway is closer to a decade in plenty of markets. So strip away the headlines, and the decision really comes down to 3 honest questions. Question 1. How long are you actually going to stay? Under 5 years, renting is close to a no-brainer almost everywhere in the country right now. 7 years or more, especially in a market with the price-to-rent ratio under 20, buying starts to look genuinely strong. Question 2. What does your specific local market actually look like? National averages are almost meaningless here. The difference between Detroit and San Francisco isn't a nuance. It's 2 entirely different financial worlds. Pull your own city's price-to-rent ratio before you make any decision. It takes 5 minutes, and it tells you more than any national headline will. Question 3. And this is the one people lie to themselves about the most. Will you actually invest the difference? Be honest about your own track record here, not the version of yourself you wish you were. If you've ever opened a brokerage account with good intentions, and then let the cash sit there, uninvested, for months, that matters. The forced savings of a mortgage exists precisely because most people, even smart, well-meaning people, struggle with consistent, self-directed investing. If you know yourself to be disciplined, renting and investing, the gap can absolutely outperform. The 2026 data backs that up in plenty of cities. If you know yourself to be inconsistent, the structure of a mortgage might be doing you a financial favor you wouldn't give yourself. Here's the real headline buried under all of this. The old advice that buying always wins isn't just outdated. The 2026 numbers show it's now genuinely market dependent. In roughly 80% of major American cities, long-run ownership still builds more wealth, even against a disciplined renter investing everything. But in the most expensive coastal markets, that math has fully flipped, and renting plus investing is the stronger play. Jordan, sitting at that kitchen table, isn't going to find the answer in a generic headline either. The answer is sitting in 3 numbers: the local price-to-rent ratio, the realistic time horizon, and an honest read on personal saving habits. Run those 3 numbers for your own city, your own life, your own track record, and the decision usually becomes a lot clearer than it feels right now. The math changed in 2026, but it didn't disappear. It just stopped giving the same answer to everyone. If this kind of real numbers breakdown is useful to you, there's more of this waiting on the channel. Subscribe to the Wealth Metrics for more data-driven breakdowns that cut through the noise and show you exactly what the numbers actually say.